Hi, everyone. I'm Mark Sir, Product Manager at Saving for College. And on behalf of the whole team here, I'd like to welcome you to today's webinar, where we'll learn how to pay the college bill with Joe Messenger, College Aid Pro. Last time we hosted Joe for a webinar, he told us a little bit about how to analyze and appeal our financial aid award letters. And at this point in the process, you've probably selected which university you'll be attending or where your child will be attending, and are ready to take kind of the next and final step in this journey in paying the college bill. So with that, I'll go ahead and turn it right over to Joe because we've got a lot of material to cover today.
Yeah, we sure do. This is my favorite part when people have to figure out where the money is actually going to come from. So hopefully we're able to give everybody some good insights, both kind of on the big picture where we're at, and then really kind of getting into granularity, kind of how we approach this, and hopefully give you some tools, resources of how to do this. So going to do some screen shares. I'm going to show a couple different things, but this is why we're here. We want to know how to pay the college bill. And when I think about this really starts with understanding, like with College Aid Pro, this is kind of really what we're all about. It's changing the way America shops for college. We really encourage people to think about this as this is a large buying decision. All too often with college, we're just basically taking what they give us and trying to account for the past. So change the way America shops for college, ending the student loan crisis one family at a time. I mean, because we hear everything in the news about the student loans and the crisis and people getting over their head with student loans, and that's why you're here. It's because hopefully you want to make an informed college buying decision and put the power back in your hands. So that's one of the big things that we say is, if we can make sure we are empowered, because this is one of the last things on the earth that's a very kind of, I would say, kind of almost intentionally opaque process. There's all these forms and financial aid and scholarships, and where do we find schools that are best for us? And at the end of the day, this time of year, you've gotten the award letter. A lot of our kids have done everything we've told them. They got into some of their dream schools. But for some of us, we really have to figure out how do we fund the gap. And that's important. So we're going to walk through, like I said, kind of strategy-wise, big picture, and then kind of go through step by step of how we would approach it. And then also specifically spending some time on the 529 aspects of how to, utilize that, do it smart, make sure you don't miss anything. So ultimately, what we encourage too is think about this in terms of a college crystal ball. So I do want to understand if we can, Mark, if you have the poll, I do want to understand who is on here, because I just want to know, do you have a senior now? Do you have a rising senior, sophomore? If you can just let us know where you're at in the process. I presume we probably have plenty of 22s, but hopefully some of you are here earlier as well, because some of this will hopefully give you some runway to kind of peek around the corner around how to approach this, paying the college bill. So we'll let it run for a couple more minutes here, but so hopefully that's the way we think about it is, if you're sitting here today and we're thinking about how do we pay the college bill, what I mean by crystal ball is, let's not just account for 1 year, let's make sure we account for all 4. See into the future. If we go here, what was the cost? More importantly, what was our discount? And then now we have our out-of-pocket cost, right? So we know what we have to pay. So for that, and not for just 1 year, but for all 4 years. That's really an important piece here as well. All 4 years of college, not 5, not 6, 4 years of college for undergrad. And if we go here, here's what it costs. Here's our budget. What's our delta, right? So if we have a delta, what I mean by that is, what is the student loans we have to take? So what's the total cost over 4 years versus our budget? What's our total loans and our total student loan payments when we're done? So that's important. Visibility, I think, is really important as you're looking at how to pay this college bill, because that is really the crystal ball. So if we can go ahead and show that, I would love to see what our results were. Okay, so we got a lot of 22s, 23s. Okay, yeah, so we got kind of a good mix here, but a lot of folks looking at how do I pay this bill coming due. For most of you, July 1st is kind of what we're looking at. So okay, great. So I'm going to close that down. So one of the things that we'll talk about today and that will feature is, the College Aid Pro, the MyCap software that Mark's going to put the link in there. If you didn't get a chance to sign up, I encourage everyone to. This is a partnership with College Aid Pro. Our MyCap solution is really about helping shopping smarter for college. And this is kind of where you can get signed up. Even if you're at the finish line here, we're going to help you through this how to pay section all the way through. So this is really when we talk about what's inside the software, it's every scholarship for every school in the country, instant net price calculators, affordability analysis, finding the schools line by line to help with the financial aid forms, aid award analysis. How do you appeal for additional aid is where we're at. And now it's basically how do we pay the bill? So that's really where we're at in this part of the process. So if you're a younger person, you're kind of in the shopping phase, but we're here to really talk about how to pay the bill. But like when I talk about the college crystal ball, what we're going to help illuminate, at this point is the actuals, right? We're going to project what we think we're going to get. We're going to project what we think that the cost is minus any potential scholarships and financial aid. And will you be eligible? Then we'll also help create a budget. So even if you're at the finish line today, if you've not created a budget, I would encourage you to do so. And that college pre-approval budget is something that once you're inside the software, we're going to walk you through on a step-by-step basis how to create that budget. Because even if you're at the finish line, going through and understanding how might we pay this college bill is critical. Okay, so we'll help you create that budget, and it looks something like this. You're going to go through an exercise that helps you understand, here's the different ways that we actually pay for college these days, right? So we use this exercise inside of the software to understand where is it coming from. So as a family, one thing I would encourage you is to make sure you've got both parents on the same page with this process as before you engage your students. A conjoined front, like many things we do in parenting, right? We want to have a conjoined front. We want to help make sure we're having a meaningful college money talk around this. And this is a real opportunity for financial literacy and understanding here's what this is going to cost. But so that we can go into this with a baseline, creating the budget is key. And then I'll go through the mechanical stuff, like I said, but this exercise, which is inside of the College Aid Pro, the MyCap portal, it's going to understand what do you have in 529s, right? Obviously, we're on here with Saving for College. So 529 plans, hopefully you've been able to utilize them. But what we find is it's with some people, that's where maybe you think your college funding plan begins and ends. Where we would say is, okay, we got 25,000 today. What do we have set aside and what we're contributing? Okay, $200 a month. That's great. So total by the time we go, here's what we're looking at. Now, the other thing is when we look at what other assets besides the 529 might you want to use and contribute for, and this is the student's name is Al in this case. For Al, what's the amount of other assets you might want to contribute? So it might be a stock or a mutual fund or something like that you have that's earmarked for college. Now, important part of this process when I say earmark is to understand this is for college for Al, right? And we're trying to get a 4-year budget number. And then we'll break it off into pieces. But for college, for Al, what do we have set aside? Because if you're like most parents, what you do for one, you would like to do for all, with some exceptions probably. But what you would like to do for one, you'd like to do for all. So if this is your first one going off to college, this does set the table and the precedent for each of the kids coming behind them. So, and going through this process, I will tell you, it really is about creating this baseline to communicate and understand what you're getting into on a 4-year basis, and have this money conversation with your students, understanding, this is the college funding philosophy. Here's how we're going to approach this as a family. And then you can go say, okay, here's how we're going to actually apply the bill. So again, 529 plans, what do you have? What do you have in parent pledged assets? And then this next one, and you see through our system, there's always going to be prompts all along the way. But in our system, it's going to ask you about parent pledged monthly cash flow. So this is one of the, for a lot of families, if you think of it in terms of how does the college bill get paid, some of it hopefully is savings, about a third for most families, about a third is going to come from cash flow, pay as you go while in school. And then hopefully less than a third is from student loans or outside folks. So we're trying to figure out, what do we have? We've got our assets, right? But also what about cash flow? So what I've learned is working with, hundreds of families over the years is that cash flow is often pretty good for some. You just haven't been able to save as much because the runway is so short for college. Don't feel bad if you feel like you haven't saved enough for college. Everybody, the vast majority of people would say that. So, but the cash flow piece, if you look at what's to the right, what we talk about is If we think of this in terms of what can we do that we're already doing for Al for college. So we're already saving money in the 529 plan. And another important piece is to understand that a meal plan at the college typically costs around $2,500 to $3,000 for the year. So a couple $100 a month is what I would budget there. So instead of them eating out of your fridge, part of the cost attendance of the university is the meal plan at the college, typically around $1,200 to $1,500 for a semester. So if you think of that, about $200 a month, right? So without changing lifestyle, you're used to saving the 200, you're used to them eating out of your fridge. So there you're at 400. And then what other extracurriculars or things did you pay for that maybe go away? So one of these, maybe you're paying for private high school. So factoring that in, but also extracurriculars, soccer and rugby and whatever these clubs that you've been paying for, just think about, okay, mentally, we're used to paying for that. So we could probably cash flow that. So hopefully that makes sense. The cash flow component is big. $500 a month doesn't sound like much, but over 48 months, it's $24,000. So the cash flow, as opposed to taking out a loan and figuring out how to pay that back, there's two things you might want to consider. Number one, the schools have what they call, basically you can put it up on a tuition payment plan. So you can go to the school and say, hey, we've got some 529s. We want to apply that, but for the remainder of the bill, we'd like to pay as we go. And they'll let you set that up over a 4 or 5 month period. It's called just a tuition payment plan. So I would caution you, look at the fees. Oftentimes they're very minimal, a one-time setup fee of $30 to $50 maybe. But again, just understand, is that an option? Because as you look at that bill for July, you might be going, oh my gosh, how are we going to pay this? Don't take the bait of just putting it on a credit card, right? Or taking the Parent Plus loan, which I'll get to in a moment. But understand, here's the cash flow that we can do. So you can either do it through that tuition payment plan to pay the bill, pay as you go, or you could also, you might want to consider flowing that cash flow back through your 529 college savings plan. So you're always kind of pre-filling for the next semester into the college savings plan. So be cautious of how much you have in your college savings plan. Make sure you're not going to overfund it. But in my experience, for most families, that's not usually the problem. So just understand, again, the goal here is, if you can commit to this today, you're going to be used to this coming out of pocket by the time they're actually going to be collecting that bill. But again, you can space it out, pay as you go, instead of taking a loan, instead of putting it on a credit card, work with the school to set that up. So hopefully that's a helpful tidbit. And like I said, for most families, it's a big part of the way they're going to pay for college. The next piece would be understand if you're eligible for any tax credits. So many of you may not be aware of this because you've never experienced it, but the American Opportunity Tax Credit is the richest education tax credit that we have these days. And essentially what that tax credit says, as it outlines on the right, if you spend $4,000 on college this year, we will give you $2,500 in your tax return next year. So some of the nuance there, it's basically dollar for dollar for the first $2,000 of expenses and 25% of the next $2,000. So all in all, think if we spend $4,000 towards college next year, right, then we will get $2,500 back in our tax return the next spring. So that is part of the college funding plan. Just to make you aware, you do have to qualify based on your modified adjusted gross income. So basically, if you're married filing jointly, if you make below $160,000, you're going to qualify for up to the full amount. If you make over $180,000, you're phased out. So just be aware, and you may want to consult with your tax professional to see if that's something they think you're going to be eligible for, and make sure that you do capture the entire credit if so. So I'm going to throw a wrinkle in here, and that is to make sure that you can qualify. If you do qualify based on the income and based on these parameters here, one of the things is the law basically states they don't want you to double dip. So by double dip means 529 plans have federal tax benefits. So does the American Opportunity Tax Credit. So the simplest way to do it is to use non-529 to meet that $4,000. And that way you'll make sure you get the full tax credit. So usually that's not that difficult if you're cash flowing through and putting it through the school, and books and all those kind of things will add up to over $4,000. So, so that opportunity tax credit, hopefully that's just helpful to really, make you aware, because if your income qualifies, just know that that's something that you will be eligible for. And that's for all children throughout all 4 years of undergrad for each of them. So any dependent, all 4 of them throughout undergrad. So just understand that if you are eligible, that's part of it. So now, as we go through here, we have our parents, and that's pretty much what we're at for the parents, right? We've got some cash flow and some 529s. We're beginning to build it up. And then the next piece is having the conversation about what you expect the students to contribute during college. I think this is an important piece of the puzzle. Do they have anything set aside from birthdays and that kind of stuff? Go ahead and plug it in, and that can, if they had $10,000, let's say, couldn't they plug that in, and couldn't that go towards the cost? And then the other piece is cash flow from the student. So cash flow from the student, having the conversation. Again, I encourage parents have the conversation first, then we communicate this with our young adults heading off to college. So if the expectation is $200 per month, but that could be made up over working over the summer, et cetera. So if it's $200 per month, roughly, or $2,500-ish for the year, just communicating that with our young adults, saying, hey, we do expect you to participate in the cost of college here. And some of that may be student loans, which I'll get to in a moment. But having this conversation, putting it on the table, now we've got student pledge monthly cash flow. And the key here is that if they work, is it for the cost of college? Is it for tuition, room, board, books, and fees? Because that's what's in the cost of attendance of the university. If it is simply for walking around money and beer and pizza money, that does not go on the budget. So that's a different piece. And I'll point out one other thing as we're looking at this. One of the rules of thumb, and I always, as I go, I encourage people to write these down. One of the rules of thumb that I impress upon parents and students is, for every $10,000 you take out in student loans, you will owe back roughly $100 per month. I'll say that again. For every $10,000 you take out in student loans, you'll owe back roughly $100 per month. And that's on the standard 10-year repayment schedule for student loans. Okay, so if we know that roughly 10,000 here, if that $10,000 you don't take out in student loans, that's $100 a month you don't have to pay back. So pay as you go is important, not taking loans just to fund all of the gap. Take as little loans as you have to. Understand what we have before we need to take student loans, and understand it over a 4-year basis. Okay, so hopefully that's helpful. And then grandparent and other help. So grandparents or rich aunts and uncles, whoever they may be, we need to factor that into the budget. So in my experience, if you're here as a grandparent or you're here as a parent, in my experience, we still have trouble talking to our parents about money. We meet with successful 45, 50-year-old couples making very good incomes, and we still have trouble having the money conversations with our parents. It's not your fault. So as an advisor that helps families like yours, I'm giving you permission to ask them, because we need to know where it's at. We need to quantify it and qualify it. Okay, so how much is it? When can we expect it? What type of account is it in? Without going through the litany of why that is super critical, understand that grandparent money coming into the school at the wrong time can really adversely impact your chances at financial aid in future years. So, like I said, just if you have grandparent dollars, you want to get an understanding of how those are going to flow in, what type of asset it is, because there's a big difference between 20,000 and 20,000 a year. Right? So is it 20,000 over 4? Is it 20,000 per year? That's a very big difference. So having that conversation, getting that out on the table, I think is really the key to really start off on this process. So again, hopefully that this exercise of pre-approval, which is right inside of your College Aid Pro account, under the profile, you can go in and create that under your profile here. It'll take you right over to go and create that budget on a step-by-step basis. And now we know this is our 4-year number, and this is our 1-year number that we can afford if we distribute it all evenly. So that key, that starts you off on your process. So, from there, if we think about how to pay the college bill, it becomes understanding, like I said, what's the difference? If we know we owe this, and how do we come up with funding the gap? So that really is the key that we see in working with families. So So I think I have an example here. So if we just looked at a family inside of the system, and we're looking at, we help you understand a dashboard, how to search for schools, shop for schools. But if we come to affordability, we now know if we have our award letters in, we know that, hey, this is actually what the 4-year net cost is. We know what our budget is, our pre-approval, as we talked about, and we also know the total student loans that would be required at this school. Even more importantly, if we know that based on our budget, we're going to show you, if you go on a 10-year schedule, here's your repayment amount per month, here's the total amount. What the government has done, and even some of our private lenders have said, we're going to let you stretch these out over 25 years. But be very cautious, because here is where, and before we get into the details, this is big picture. You can cut your payment almost in half, but you'll pay them almost 3 times as much interest and be in debt until you're 50. And I don't think that's what any of us envision for our young adults. But that is the trap many of us are falling into. They're saying, we've got your back. We're going to help you understand this school. But the reality is, what is it worth? What's the cost? And more importantly, if you go to this school, what's the likely outcome in this major? Right? So this is the college crystal ball to say, look, I don't think we're sacrificing quality to go to MIT. Right? I don't think so. Just because of the way they run their business and how the financial aid works, we're going to come out of that school with significantly less loans, right? So understanding, these are both great institutions, but when we look at this, look, our payments, what we're making on these and what the out of pockets are, like our salaries aren't that much different. So again, that's kind of the key to getting started, is the pre-approval budget, and then understanding like what's our affordability on a side-by-side basis. I'm going to get back in here. So I'm going to shift gears and go a little bit into kind of like education funding, the process, the vehicles that might be being used, and then being careful on the distribution of those to make sure that we're getting, making sure we have qualified distributions, et cetera. So depending on where you're at in the process, as you have younger students, the approach has been, here's the things we need to factor in and consider, right? So we need to understand, like when you're pre-college, we've always approached it this way. We're accumulating for the cost of college. The primary focus is saving for college. So we're going to look at what's the cost today. What does the private school look like? What's a public in-state, public out-of-state, elite privates? These schools operate their businesses very differently, and their costs are very different. So I tell you, the good part is once you're here at the finish line, you really begin to realize that the sticker price was irrelevant the whole time. Because hopefully you're at a point where you received great discounts and you're really just figuring out, how do we pay the net cost? So if we've used these things to get us to where we're at, we're going to basically be looking at, if you're looking at what's our college funding philosophy as a family, I encourage people just to go through this exercise to figure out, if we have whatever the age of our child is, let's figure out what our philosophy is. Do we want to look at a private college? Because if so, here's what the projected cost is, the projected total cost of attendance for 4 years once we get out there. $390,000 would be the all-in if you had a 10-year-old today. That's assuming the school goes up at 5%. So let's assume we get a 5% rate of return. All you'd have to do is save $3,300 per month for the next 8 years. For most families, that's a pretty tough pill to swallow. So we begin to think, how can we think about this a little bit differently? Can we come up with maybe a quarter of that cost? Because what I know of the cost of attendance, most private schools discount their tuition over 50%. Right? So if you're at this paying for college phase, this is important, because if you've accumulated, you're now realizing, okay, we didn't have to save for maybe the entire cost because we got some great discounts. Understand the average family that we saw that went to private college within our system last year, they actually saved about $35,000 per year off the sticker price. So that's $140,000 less than what this may have projected. And that's because of great scholarships and need-based financial aid. So again, it's very unique. It's unique to you, but just understand, when you're looking at saving for college, private schools, the average discounts are significant. Just understand, these are the kind of exercise I would encourage. And then the next piece would be looking at, what about a public school? Well, obviously the numbers are different. The 4-year cost is about a little less than half. So what we need to save is obviously less. So again, if you're a family, you're looking at this, I think making sure that you can communicate what our goal is, because Oh, by the way, you'd like to stay on track for an on-time retirement. How do we think about this goal? How much do we want to help them pay towards the cost of college? And at this point, if you've got what you've got, but you said, hey, we want to commit to funding 50% of this goal, but maybe you've only got half of that saved. Okay, well, we got to cash flow the rest. Okay, because that's what we committed to. That's what we would like to do for the students. So, hopefully this is helpful. You're at this phase, you're figuring out how do we apply what we've done. We've saved what we can. Now we got to go actually make it happen. And I will say for those of you that have, underclassmen, it's never too late to start saving. Never too late, right? So even to and through college, we encourage some people may use the college savings plans to fund this college education expense. But the big thing is make sure you're not getting in over your heads with student loans, and understand visibility into the future, like the crystal ball, like I talked about. So where can we save? Where have we saved? What we look at is 4 kind of key things for you to understand. And this is important on accumulation, but it's even more important on distribution. So when I look at like how you get to the top of the mountain, meaning like your kid is approaching graduation years, you've hopefully accumulated some dollars, you've put some into 529s, you've gotten the great tax benefits. Our goal now is to understand not only how we saved, but how to come down the mountain, right? And make sure that we do it the right way and make sure we're not losing any tax benefits or anything like that. So when we look at, the predominant tool has become the 529. So I presume many of you have probably used the tool, but we look at operationally, how flexible is it? What are the investment options? How flexible is it there? What about taxes? And then what about financial aid? Right. So this is a chart, and you'll get the pieces as follow up, but like understand when you're accumulating and distributing, this is important stuff. So the 529, why it's become such a great tool, because operationally it's very flexible today. And I'll go through a number of those, what are my options, et cetera. Investment wise, the investment options available have become much better. But one of the things when I look at investments and flexibility, I would encourage you to look at your asset allocation today, because what I find is a lot of times people are over invested given that they need the money very soon, right? So at this point, whatever investment vehicle you're in, you should not really be in the stock market much, if at all, because as we've seen since the beginning of the year, unfortunately, stocks are way down. So when you have an investment time horizon of 2 years or less, you basically want to be in cash or very safe instruments that are out there, because we'd rather preserve principal than take that risk with our money. Because we know we need it. So it's just kind of a shift in mindset from accumulation to decumulation, and also knowing that you get to a point when you need the money, like I said, you don't want to take the risk, because there's more of a risk in not having the money, because now we can lock it in, preserve that capital, make sure it's there to fund college next semester and the following. So hopefully that's helpful. With these plans also, the age-based plans do a lot of that for you these days. So, with these age-based plans basically say that, hey, if we're going off to college in 2022, over the last, 15 years since I've been invested, we've gradually gotten into less and less stocks and more safer instruments. So take a look at your accounts, make sure that they are appropriately invested. I think it's important for all these grad years that are on here. But yeah, in particular with the class of 22, we're just not looking to kill it with investment returns, because we'd rather have it to be able to pay the bill than have the market take it away. So with college savings also, we look at the tax and the financial aid. So with tax, the 529 college savings plan, it goes in, you've already paid taxes on it. It's going to grow tax deferred. Then you're going to hopefully make it as a qualified distribution, which I'll go through in detail what that looks like. And then from a financial aid standpoint, people will say, well, if I put money in a 529 plan, am I penalized for financial aid? Well, no, not really, because I think it's actually pretty good. It's not perfect, but it's good in the sense that it's only assessed in the parent's name. And that's only the most they want out of that is about 5.6%. So call it 5% is what they want. So if you have $100,000 in 529s, they're going to say, we want $5,000 of that next year towards college. So, it's pretty good from a financial aid standpoint, great from a tax efficiency standpoint. And if you have some of these other instruments, understand too, we're talking about accumulating and distributing 529 plans. I do caution people that you may want to create some flexibility in how you're saving. So 529 college savings plans are great. But if you're somebody going, well, gosh, what about What if we don't need it all, et cetera? There's a lot of flexibility which I'll go into, but you may want to consider diversifying and saying, we're going to put some in the 529, but we also want to keep some flexible in like a taxable just investment account. You lose some of the tax efficiency, but it's about the same from a financial aid standpoint. Investment flexibility goes way up, and operationally, that's a very flexible account. Another popular one that people may have accumulated in is their Roth IRA. So this has become kind of an earmarked asset for college. So if you're at this point, I'm not advocating you raid retirement to pay for college. Don't mistake that. If you're on track for retirement and the Roth IRA has been earmarked for education expenses, the reason it works out well is because it is a tax efficient vehicle, and there is a provision inside of the Roth IRA that allows for distributions, even of gains, to be taken out without tax penalty. Right. So that to me is an important piece of the puzzle. But be cautious if you are a financial aid candidate. Those distributions, they're not taxable, but they do show up as untaxed income in the following year. And that can have an adverse effect in future financial aid years. So again, these are I'm trying to hit on really the high hats in an hour here to make sure we get to and through all the presentation to show you exactly how to pay the bill. But hopefully that's helpful when you look at the context of, again, accumulating, and now we've got to decumulate, make sure that we're tax efficient on the way up, and then also make sure that we're not losing any tax benefits or anything on the way down. So that hopefully that's helpful kind of on the mechanical pieces here. High level, create your budget, right? We've already done that. What are the key features to understand? And then now we get into the 529 plan. So I really want to spend a good bit of time on this particular option because it's really the way hopefully a lot of you have saved and accumulated to get here. So when we talk about, obviously the big thing is, excuse me, tax-free growth of the 529, put the money in, grows tax deferred as long as you use it for qualified higher education expenses. The growth on that money is not taxed. So that's fantastic. So a couple things to point out. Be aware if you qualify for any state income tax deductions for qualified contributions. So why is that important at this phase? Is we're looking at paying the college bill, right? So we're looking at how do we do that? We talked big picture, but within the 529 plan, what do we take out and how do we take it out? But also, if we know that the state that we live in provides a state tax benefit for contributing to the 529, we may want to consider continuing that contribution through college. So a case in point on that, I have a lot of clients in a firm based in Ohio. So Ohio provides for the College Advantage plan and the plans that they sponsor, up to $4,000 you contribute will qualify for a state of Ohio income tax deduction of around 5%. Right. So if I put in $4,000, essentially that gives me $200 back on my state of Ohio tax return. So, it's not killing it, but 5%, that's meaningful. So it's kind of like a why not? And the beauty of that too is it earmarks it for college for that student, right? So up to that amount. So understand, some states have unlimited, some states have up to 10,000. So understand if there's a state tax benefit, you may want to consider continuing to fund through your 529 through college to make sure you qualify. So hopefully that's helpful, and make sure. So the question becomes, okay, we're looking to pay the bill. What is a qualified higher education expense? Basically, the way that I think about it, anything that the school can bill you, that is a qualified expense. So when they look at the cost of attendance of the school, those qualified expenses are tuition, fees, books, room and board, equipment, and supplies. Right. So pretty much anything on that bill you got from the college, that can be, that you can use 529 funds. So I get the question every time, can it be used to buy a car? And the answer is no. So that is an interesting piece to be aware of. So, and I won't spend a ton of time, but I do think it's important when we're looking at paying for education expenses, some of the enhancements to the qualified expenses of the 529 plan. So one of those is K through 12 tuition expenses. So it's limited to up to $10,000, right, that you can use for K through 12 tuition expenses. Now, note I said tuition, right? It's only tuition. They're presumably living at home. It doesn't allow for room and board at like a boarding school and things like that. But it has opened it up to $10,000 per year can go to K through 12. So that may be part of your education funding plan right now. And then the other piece is up to $10,000 lifetime for qualifying student loans of a beneficiary and sibling. So if you're done with school, you've got monies left over, you can use up to $10,000 of that 529 to pay off student loans. So I'll get into a smart lending strategy because it's a big part of paying the college bill. And I'll hit a little bit more on those particular aspects in an example. So when we look at these other pieces here, hopefully the maximum investment around $300,000 per beneficiary. One of the things I'll say is that if you're at this point, you've got dollars set aside, you may want to consider how much do we put in, because you can put in, you can advance gift up to 5 years into the plan. So really you could put in, I guess it's $80,000. You could front load into a plan if you wanted to. So a little bit beyond the scope of what we're talking about today, but if you wanted to earmark the money, you wanted to put it in so that you know that college is funded, there are high contribution limits that you can put in. And by the way, anybody can put into your 529 plan. So grandparents, aunts, uncles, friends, whoever, anybody can contribute. And I encourage you to utilize that strategy to get more people, to get more money into that college fund. No more toys, no more anything like that. It's going to go towards college. So one of the other pieces too is the flexibility of those expenses, and then to change beneficiaries, right? So I think that component of being able to potentially pay off student loans is great, but being able to change beneficiary maybe to a younger sibling, pretty easy to do, pretty flexible. So anybody to as close as a first cousin could be the beneficiary of that. And if you're looking at this, a couple things to point out too, when we talk about changing beneficiaries. Quick drink. Oftentimes we've got multiple kids. So I do really encourage the bucket strategy. So what I mean by that is if you have 3 kids, earmark for each of them, here's what we're going to put into each one. So because their timing's a little different and the amounts may be a little different based on those goals. So I encourage, and then having those earmarked for that student for college. You're going to have some differences in investment returns, but at the end of the day, it's just really important to make sure you're earmarked for that student for college. And then there's flexibility. Like I said, if there's dollars left over, you can decide how we maybe change those around, is something that it's really available. So I'll bring up one other piece on the flexibility to change beneficiaries. And that is, for a lot of families, they have questions around 2 things. What about scholarships, and what do we do with it if we don't use it all? Okay, so what about scholarships? Scholarships, there's a provision within the 529 statute. It's state by state, so make sure this is the case, but for most of them, this is the case. If you have a scholarship, you can withdraw funds up to the amount of that scholarship. You will pay taxes, but you will avoid the 10% penalty. So typically, if you took a non-qualified distribution of a 529, you would owe taxes on the growth of the money, and you'd also owe a 10% penalty. If the money is used and it said this is a pseudo-qualified expense, because we're pulling it out and we're going to offset that $10,000 scholarship with $10,000 distribution. Okay, what they would do is they say, here's $10,000. They're going to say, how much of that is money you invested versus how much of that is money that has grown in the market. So let's say it's, for simplicity's sake, 50-50. You have $10,000, $5,000 of that you put in, $5,000 the market gave you. When you pull out that $10,000, they're going to say, okay, here's your $5,000 back. Okay, now this $5,000, we're going to count this, and you are going to have to owe taxes on that, but we're not going to assess the additional 10% penalty. So that's a pretty good deal, because you've got free money coming in that you were expecting to use that college savings plan for. So you can withdraw that. Be cautious. You always want to make sure you track your distributions, keep records of them. But hopefully that's a good example with a scholarship, because we get that question a lot about when we take this money out. What about scholarships? In lieu of that, what most folks choose to do is let it ride. So what I mean by that is they'll either let it stay for grad school, because this can absolutely go towards grad school, or if there's another sibling, they can just keep it banked for that younger sibling if they choose. And then some people, when there's dollars left over, I call it a legacy 529 plan. So let's say you get through this and you've got $529 left over. And let's say there's $10,000 left. You go, great, what can we do with this? We could cash it out. We could pay some penalties, et cetera. But, we could maybe leave that in there for 30 years until our kids have grandkids and we have grandkids. And that money is going to grow tax-free for a long time. So if you're looking at this and how to pay the bill and you think there might be some 529s left over, I would be, remiss if I didn't say like, hey, if everything else is funded well, you might want to look at leaving those in there. It's a heck of a gift, and growing all that time without taxation could be really huge. So a couple strategies there. Hopefully those are helpful as you're looking at these pieces of the puzzle. So I think we talked through some of there really isn't income restrictions. Investment wise, most of them have gone to an age-based. I mentioned you want to take a look at you would want to take a look at how you're invested, make sure that you're not over invested in this process. Okay, so we hit on a few of these already, so I don't think I'll have a ton to say here, but this will be in the slides just so you can pull them out. We talked about what's eligible. We talked about the $10,000 per year beneficiary as a qualified distribution, and that ability to pay back student loans. One thing in here as well is that the 529 plan, as part of some of these enhancements, I would say, is that they are eligible as long as it's qualified higher education for a number of apprenticeships programs. I think as part of the Secure Act, they really kind of expanded what you could do with these. And I think that was a great move to get everybody kind of what they need, because we need those jobs desperately. I think we all see that in our local communities. So that's on the 529 plan. So I think I'm going to skip through this. This is a K-12 example. Let's see. Let me see. I'll hit on here. So I just, this is an example of K through 12. I put it in here. I remember why I did it. So we have to have 3 examples of people here. We're looking at kids that are, looking at K through 12 tuition. Because paying the higher education expense is the reason I kind of wanted to bake it in here, because it is unique to the K through 12, what the rules are. So I just wanted to give some concrete examples if this is a scenario you're looking at of how to distribute your 529. If you have tuition expenses of $6,500 and you do a distribution of $7,500, qualified $6,500, non-qualified $1,000. Right. So that's kind of like you can only take out what the tuition expenses are. In this case, you have $9,000 of expenses, you take out $9,000, everything's qualified, you're good to go. In this case, for this last one, if it's $18,000 and you take off $18,000, they're going to say $10,000 of that, because it's a maximum of 10, is qualified. The other 8 is the non-qualified distribution. So in this kind of, understanding kind of like this piece of the puzzle too, because like if your expenses, you can't take more out of the 529 than the expenses of going to school. So it's kind of the same if it's K through 12 or otherwise, there's no limit on the amount. So, so just understand this is a specific example for K-12. The college bill is a little different. We hit on most of these. So I'm going to hit on, so we went through, big picture, how to create your budget, right? Understand here's how to create that budget. What are we going to use of our money before we take out any student loans? We've talked about how to strategically distribute the 529 plan. And now, and what some of those parameters are. Hopefully that's helpful, put it together. And then the last piece is, what if we do need student loans? And I call this creating a smart lending strategy, because all these loans are not created equal. And I think there's a lot of confusion around, which ones do we use? How do we use them? Who's liable for them? All that kind of stuff. So creating a smart lending strategy is where we're at. And then I'm going to get into really how to pay the bill. So at a high level, Mark, I tell you what, if we have some questions before I get into the lending strategy, this might be a good time to just take a
definitely.
Great.
One Fafsa question here, Joe, especially when we're talking about having different 529 plans for different children, there's a question about whether the Fafsa requires you to report the total amount of 529 money that you own. And I think maybe we can just talk a little bit about like the beneficiaries and the account ownership issues there.
Yeah, it's a great question. So long story short, when they're asking 529, they are asking, what do you own for all students? So example there, if you have 3 kids, they each have 25,000. The answer that the FAFSA wants is 75,000. So, so that's kind of the general answer for that. And then I was going to say, so if we look at that, falls in as an assessable asset on the FAFSA of the parent. And I think to your point, every 529 has one owner, one beneficiary attached to it. So you're going to have an owner and a beneficiary. So understanding who that is and why that's important. There are some changes coming to how grandparent 529s are looked at. So I probably should open that can of worms, but there's some changes that there may be some opportunities for people to accumulate a grandparent's name in the future. So.
And following up on that, a similar topic here, there's a general question just about changing the 529 beneficiary from a parent to a child. Any concerns or considerations about that?
So it really, for the FAFSA, it follows the who the owner is more than the beneficiary, because even if you're the owner of your own 529 as a parent, that's going to be considered as a 529 that you own on the FAFSA. So as a student, it's kind of neutral, I would say, but not a lot of, there's no tax ramification or anything like that. And from a financial aid standpoint, it's kind of neutral. One interesting thing we do see from time to time is that they've actually established a 529 for the student to be the owner and the beneficiary. And in the eyes of the logical thing would be, okay, this student owns this. So that gets reported as a student asset. Whereas the FAFSA rules actually say, even if the student owns a college savings, 529 college savings plan, it actually is reported as a parent asset. So it's kind of an interesting one. And I will say that, there's some nuance here. One of the biggest mistakes I see, Mark, when I meet with folks and kind of audit their FAFSA is that they own a 529. And either they're only reporting the 529 for the one student, which was kind of the question, but oftentimes they report it as a student asset. And that's a big no-no because the student asset's assessed as high as 20%, whereas the parent asset, where it should be, is only assessed at around 5%. So that's just to make sure you're reporting all 529s and make sure it's a parent asset, not a student asset. So hopefully that's helpful for.
There is a question for clarification here. Is there a $10,000 limit to 529 plan money that we can put toward college tuition? That is not the case.
That is not the case. That's just the rule for the new K through 12. So there's a limitation of K through 12 that you can only put $10,000 and only towards tuition. So I'm sorry if I muddied the waters, but yeah, college, it's up to what they charge you, what you got to come out of pocket for. You can, that's a qualified distribution. So there is no limitation on that. That's only for the K through 12 tuition expenses.
There's an interesting question here from Gary on qualified expenses. If the student has a partial meal plan and his additional meals are charged on the parent's credit card, would the parents be able to reimburse themselves from the 529 plan? And is there a set allowance per meal if so?
Yeah, it's a great question. And I didn't get into it a ton, but it gets into how can you take money out of the 529? So, and that is you can take it and you can say, hey, and this is for a lot of families very easy. Here's this amount, send $10,000 to the college for the bill. Or you could say, send that $10,000 to me. I'm going to keep my receipts and I'll pay the college myself. So that's at a high level. So this question of what happens when things aren't direct billed from the school, you can look at what they charge for a full meal plan and also for their for the housing. So if somebody goes to live off campus, that is also a qualified expense, as is food that's not billed through the meal plan. So like you want to look at, and what they'll provide you typically is, if you were here, you were living on campus, this is what it would cost for your room and board. And that's what you can, legally, ethically pull out of your 529. And that's very common, right? Especially as you get into second, third, fourth years, whatever the school states that is their room and board, that is what you can take out. So hopefully that's helpful. So, because it doesn't have to be like every single receipt, but as long as you don't say, yeah, we spent $9,000 on meals, that's a no-no. But if you say, okay, we actually didn't do a meal plan, so what can we take out to pay for meals? You can do that.
Right. And another clarification question here that the 529 can be used for K through 12, but in some states, those folks will still owe state tax. That does just depend on the state. If you go on savingforcollege.com, you can go ahead and take a look at the particular state that you live in and whether they follow federal tax-free treatment for K-12, as well as student loans, because certain states do not follow that. And then the last question here, Joe, that I'd like to pose, because this one's come up a couple of times. It also came up yesterday when we did a similar presentation with financial advisors. If you've got half or so of the expected costs saved, do you want to front load that? Do you want to back load that, or split that kind of evenly, across the 4 years? One thing I'd like to mention here is that your financial aid may change. So for example, I actually was able to earn close to $10,000 in additional grants from my university because my grades were good. So it is possible to increase your financial aid in the future. I just wanted to mention that.
Yeah, I think it's a great point of, like, you always ask for more money every semester, because once you get into the university, then you get into the college, they may have major specifics of how you can earn more dollars. And I think I will hit on how to map that out when I get into smart lending strategy, because the temptation oftentimes is, oh, we've got the 529, we'll pay for year one and then we'll deal with it later. Where actually understanding what your total 4-year outlay is going to be, and having a smart lending strategy, knowing what your overall gap will be, is important, because it's and I think I'll hit that here kind of in the lending strategy component, because it's important to coordinate every piece of the puzzle. So when we talk about the steps of the puzzle, so I'm actually going to go into this other piece, and I think if we're ready to go, I'll hit through kind of the options to cover the shortfall, things to consider there before we get into the smart lending strategy.
Excellent.
Cool. All right. Great questions. Keep them coming. So when we look at this process, am I sharing yet? No. Let me get back to sharing. Sharing is caring. So this is something we use just to frame this up, which I'll put in the follow-up, and that is our 6 critical steps. So we've done the prepare for the cost. We've done the application for admissions if we're here. We've applied for financial aid. We've even done the analysis and appeal for financial aid offers. So for you underclassmen, you'll have this handout, and this is exactly what the College Aid Pro, the MyCap system, guides you through. Preparing for the cost, applying for admissions, analyzing appeal, really all the way through the process, and then down to how do we strategically pay. So we went through this in pretty good detail, the college pre-approval process, understanding your schools and how to find and do this proactively instead of reactively. Now we have to say, what are we going to pay? But applying for admissions, financial aid, and then we analyze and potentially appeal for additional financial money. Our best appeal this year was about $12,000 of additional scholarship, $48,000 over 4. So that's what our expert consults can do for folks. And then choosing the school, we accept the award, and then ultimately to the point of the question around how do we time this out? You really want to take a look at all 4 years and determine what's the asset, income, tax strategies. How do we put all this together, given what we know now? And then we want to make sure that we know distributions from savings and investment accounts. How do those impact tax credits and deductions, right? Coordinating contributions from other family members. Can those all come at the front? Should they wait till the latter years? Grandparent 529s, for example, may be worth considering using those in the latter years just because of the way they impact financial aid. So if tri-generational planning is something that's part of your questions, if you have grandparents, make sure that I reach out and we can talk about how that might help. And then selecting the proper loans. So all of these go into creating a comprehensive college funding plan. We've just got a few minutes, but I'm going to hit through the smart lending strategy because I think it's critical for most families to understand this. And then we'll just show an example of what it looks like to map this out with our how to pay tabs. So the smart lending strategy, Federal Direct Stafford, these student loans. So there's 2 flavors of the Federal Direct Student Loan, and there's also the Federal Direct Parent Plus Loan. And there's also Federal Direct Grad Plus Loan. But we're going to focus on these 2 federal programs that you all are eligible for. So the big thing with this is you have to fill out the FAFSA to be eligible for the Federal Direct Loans. So even if you weren't eligible for you thought, we're not going to get any need-based aid, so why fill out the forms? Well, in a lot of cases, this student loan is the reason why. So you have to have filled it out. And even if you're at this end phase, you can still fill out the financial aid forms for about another 3 weeks to be eligible for these federal direct loans. So just FYI, if you're at this point of the puzzle and you haven't filled them out, you can still do that and be eligible for the loans. So the way that these come in, They're actually part of your financial aid award letter, and then are also part of your financial aid portal for you as a family. So what I mean by the portal, if you're at the end phase, everything's done electronically for the most part. They may notify you with paper, but one thing I encourage is make sure that your young adults are checking their email every day, because there's a lot of stuff that comes at them between now and then. So if you remember filling out the FAFSA, it's the student that fills out the FAFSA and they provide your information as a parent. And they have an FSA ID, Federal Student Aid ID. That Federal Student Aid ID is now attached to their financial aid filings, as well as their student loans and their student loan repayment. So they've done a nice job of kind of packaging this up. So for the federal direct student loan, so just mechanically, hopefully that helps. And then when we look at like what is eligible here, there's two types of federal direct loans. There's subsidized and unsubsidized. Subsidized just means you have to qualify based on need, and there's no interest that accrues while you're in school. So if you get offered those, kind of a no-brainer to take them out. Unsubsidized says basically if we are we don't qualify, but you're still eligible for the loans. So there's interest, but pretty reasonable interest rates. These are all in the student's name. There's no cosigner required, and it establishes tremendous credit. So, that tremendous credit is a big one. And then also for a lot of parents, this is the skin in the game, so that the student has to sign off on, I understand I'm taking this and I'm responsible for it. So even if you plan to help them pay this back, it's going to be very helpful for them establishing credit. And it also makes sure that they're understanding and getting that financial literacy of this is what this loan is, this is what it means to take this out each year. The key with the federal direct student loan, it's use it or lose it each year. And I would suggest if you need student loans at all throughout the 4 years, you strongly consider using it from the beginning. So use it or lose it means you're allotted $5,500 as a freshman, $6,500 as a sophomore, $7,500 as a junior, $7,500 as a senior. Now, the temptation may be to the question, I'm just going to use 529s. I can cover year 1 and year 2 and we'll figure it out. Well, you can't claw back and get that $11,000 of student loans you would have been eligible for. So you might want to consider taking that now, preserving some of your other monies and spacing that out over time. Because if not, you're probably going to end up taking the 2 latter loans, which are a Federal Direct Parent Plus loan or a private student loan. Now, the Federal Direct Parent Plus loan, I got to tell you, they're way too easy to get, so don't fall into the trap. It's on the financial aid form. They'll literally say, here's our cost of $50,000. We're going to give you 25. You owe 25 here. Click here to take your Parent Plus loan. It is a loan. It is in your name. It is non-transferable, and it has high interest. If you absolutely need it, you can do it, but you may want to consider, make sure you understand it's over 10% in the first year because the origination fees and the interest, and these will reset each July 1. So be very cautious. I think the worst I've seen is somebody took out $30,000 each year for 4 years, and they woke up with $120,000 in student loans. And they were in their late 50s, and their retirement was now derailed. So they had this new liability called the Parent Plus loan. You cannot transfer that to your kids. So the alternative there too, private student loans. This is a loan with a bank. So different interest rates, different terms apply, can be fixed rate, can be variable, cosigner almost always required, even if the student takes it. So you can do it as a parent, take out an education loan, or do it as a student, but ultimately they all require a cosigner anyway. So, that's just understand that going in, you're ultimately probably responsible anyway. So these bottom two, look at it as a loan program. If you've got good credit, you might want to consider other loans. I discourage taking money out of retirement plans, obviously, but if you need loans, you might want to look at a home equity line of credit if the rate's good. These things are always changing year to year, so be careful with how that works. But hopefully that helps understand the use it or lose it with the Federal Direct and utilizing those for strategic reasons. And then I'll just do a quick inside to show kind of how we really look at this on a how to pay basis. Once we get into schools and we understand here's what we're looking at, we really want to understand and map this out, and we will help you do this within our technology and with our consultants. But if we looked at Harvard, we're going to understand, okay, here's what it costs, but here's the discount we got. So we know that instead of paying $351, we're only going to have to come up with $164. And then from there, we use that pre-approval amount to map out what is the timing of that. How do we apply our 529s? What about assets? What about our cash flow? And also, what about the grandparents? So really mapping this out, and understanding what's the right time to use which resources, all the way down to what types of student loans, what type of federal, do we want to take out private student loans to fund the gap? But ultimately, what we want to know is exactly how we're going to pay for all 4 years down to the penny, including the resulting loans and loan payments. And that is visibility, that college crystal ball. Here's what it's going to cost. Here's what you're going to make. Here's your student loan repayment on a 10 and a 25 year. So we would recommend, if you're at this paying for college phase, hopefully this is a good roadmap. If you're younger in the process, you've got a junior or below, do this proactively. Don't wait. Get in the program. If you've got a freshman or a sophomore, this is the time to get in here and proactively look at what we have. A college crystal ball. It's called the MyCap solution. So, that's really, if you go in, you create this, it's a free account up to 3 schools side by side through our partnership with SFC. So I'd encourage everybody, I know we're going to send this link out, but if this has been helpful, if you get into the technology, it's basically self-guided by myself and my partners of exactly how to get to and through college with manageable debt without robbing retirement. So hopefully this is helpful. I can take maybe a couple questions, and I do got to jump for another call.
Yeah, thanks, Joe. Appreciate that. There is a question here about federal loans and the repayment structure. I think that would be great. The specific question is, how soon do we have to repay the FAFSA related loans? So I think it would be great if we can cover that one.
Sure. Yeah. So your loans are, while you're in school, no payment is required. You can choose to pay them. And one thing I didn't mention is you don't have to take all of it every year. So if you say we only want $4,000 per year, you can take what you want and leave the rest on the table. It's up to you. But yeah, so the general rule is 6 months from the time you graduate is when you'll be expected to begin repayment of those student loans. If you go back to grad school, they go back into forbearance. But 6 months after you graduate is kind of the standard.
Excellent. And then just one last clarification here on federal loans. When you say use it or lose it, does that mean if you get offered these subsidized and unsubsidized loans and you don't take them as a freshman, will you not be offered them at all as a sophomore or junior?
It's a good question. So I understand what they're saying. So if we say we don't want them as a freshman, can we get them as a sophomore, junior, senior? And the answer is yes. As long as you fill out the FAFSA, you would be eligible for that next year. So when you fill out the financial aid form, you're doing it in the fall of the year before for the next academic calendar year. So, if you're filling them out here in the fall of 22, that's for your 23-24 financial aid. So even if you chose not to take them, doesn't mean you're not going to be eligible. You just can't go back and get that money from that prior year.
Awesome. Thank you, Joe. And that's all of the time we have today, but we will be hosting Joe as well as another panelist on the 26th to celebrate 529 Day. So especially if you're a parent of younger children and you have specific questions about 529 plans and college savings, that'll be a full Q&A session. So we'll try to answer as many questions as possible. So have a wonderful rest of your day, everybody. And we'll be following up with the recording and slides.
Thanks, everybody. Appreciate it. Thanks for the time. Good luck out there.